Hello and welcome. Today I'm going to show you a calculator that I've built, and it compares the different investment types and the taxes on them and the effect of these taxes. So let's go right ahead. As you can see, there's a busy Excel spreadsheet in front of us. It's called the after-tax returns for individual spreadsheet. I've built a similar one for trusts and for businesses. In this case, we're only going to focus on individuals. In other words, if you are an individual with an ID number and you invest money, not a business, not a trust. What we're going to do is we're going to look at a 5 million Rand investment for client Joe Soap. And on the right-hand side, look here at net result. We want to achieve a similar as possible result here. And by reverse engineering, we can see what kind of return we require to get to that similar result. That's the best way I can show you the effect of different return outcomes. In other words, if you earn a certain percentage of interest at the bank, in this case 8.5%, it doesn't mean if you earn 8.5% in a different investment that it has the same outcome. We have to make some assumptions with this video. So in this case, we're going to assume that the client earns in a 45% marginal tax bracket. And these calculations change slightly when that tax bracket is not that high, but ends up being quite similar. So the four types of investments we're going to compare is the type 1 is a bank account or interest in a bank account. Type 2 is an endowment. I'll explain the CGT only concept just now. Type 3 is a LISP or a direct unit trust option. Type 4 is a guaranteed investment plan. In other words, type 4 is an investment that pays you an income after tax. Tax is paid by the service provider. Right, the CGT only option that I've explained here, it gets very complicated if you have to look at the actual portfolio that the person is invested in for a case study like this. So we're going to assume that the person is invested quite aggressively in both these cases, the LISP unit trust option and the endowment option, because that's the only way we can make a direct comparison. And in my opinion, which is a discussion for another topic, I would suggest an endowment usually be invested quite aggressively because the tax advantage is better if you are in a high equity portfolio. That's for a different discussion. Right. Let's go through the bank account case here. So if you invest 5 million and you get 8.5% interest rate per annum, that's 425,000 per annum. The value you get pre-tax is 5,425,000. You get an exemption of 23,800, and the inclusion rate means the full amount of growth that you get gets taxed. And the total tax, after we've removed the exclusion or the exemption and we taxed it at 45%, gives you a 5,244,460 Rand result. Now, we're trying to get these figures as close as possible. So, in an endowment, you're only going to need 5.55% return to get the same result. In a direct unit trust or LISP option, you're going to get you need a 5.78% return to get the same end result. And in a guaranteed investment, you need a 4.88% gross return to get the same net result. Okay, let's break these down. Why does an endowment only need 5.55? So in this case, endowments are taxed at a lower tax rate than 45%. So they are taxed at an effective 30%, but it's not the full amount gets taxed at 30%. So you end up with a low percentage point, which is about 12%, or it is 12%. So 30% at an inclusion rate of 40%. If you look at the bank account, the interest bank account case we looked at here, the full interest that you earn gets included, then you get a 23,800 exemption, and then the tax gets applied on the amount above that. Right, back to endowments. So on a 5.55% growth, you're going to have 277,500 gross growth. Your value pre-tax will be 5,277,500. And if you apply the inclusion rate of 40% times the 30% endowment tax rate on capital gains tax, CGT, then the total tax you pay is 33,300. So you pay much less tax on the endowment, only 33,300 versus 180,540 on the interest-bearing investment. On a LISP or unit trust option, you can get the same result by having a 5.78% return. Okay. Now, what's the reason for that? The endowment, you can see, has a fixed 30% tax rate with an inclusion of 40%. The LISP or unit trust option has a 45% tax bracket. In other words, it's linked to your actual marginal tax rate that you are earning. So 40 times 45 gives us a tax rate. And here on the capital gains tax exemption, you get 40,000 capital gains tax exemption. On interest earning investments, which is not capital gains tax, it's an interest earning, you get only 23,800 exemption. So after this calculation, total tax you're going to pay is 44,820, and this gives us a net result that's very similar to these two. Then a guaranteed investment plan. This is where the provider gives you a return. You don't have to worry about any taxes. You don't have to worry about anything else in the investment. And net result here, 5,244, you can get by earning a 4.88% growth per annum. So what is the final result? By the way, none of these investments are specifically better than anything else. It depends on a lot of factors, and that's why I suggest you talk to a professional that takes these factors into consideration for your specific situation. So in this case, a guaranteed investment plan will give you the best results with the lowest return. But these are usually fixed returns that are usually not too high when you ask for these returns from any provider. And then, as we can see, an endowment is the second best, then a LISP or direct unit trust option, and then interest in the bank account, because you need the highest return amount for the same end result. Hope that makes sense. If you have any questions about this, please feel free to leave a comment at the bottom. I can't promise that I'll answer all of them, but I'll definitely see what I can do. Thanks for listening to my video. Please like and subscribe, and have a good week further.